welcome on Thursday morning, almost 9 a.m. sharp. So we're going to start the session, and first speaker is Karl Friedrich Israel of Leipzig University, and he's going to be talking about the fiat money illusion on the cost efficiency of modern central banking. So welcome, Karl, with applause.
Okay, good morning everyone. I'm very happy to see you all. I'm happy that you made it at this early hour after such a packed first day of the conference. I think my topic is very good for the start because the idea of the paper is very simple. It's in essence, it's just an accounting exercise. Okay, we will look at the cost efficiency of modern central banks. This paper is an extension of an earlier publication of mine in the Economics Bulletin, where I specifically look at the Eurosystem and its cost structure. And here in the paper that I present today, I also look at the Federal Reserve system, the Bank of Japan, and the Bank of England. So we have the four biggest central banks or central bank systems in the world. What's the motivation for this paper or this research in general? It's the classical cost-saving argument for the classical economists have argued for fiduciary elements in the money supply, not so much because it would make monetary policy more flexible, but because it would be less costly to produce. Right? Fiduciary media are less costly to produce than genuine metallic money, gold or silver. And the classical economists, of course, were well aware of the dangers of such a flexible money supply, especially when it is controlled by governments. And so their argument for fiduciary media or fiat money was essentially based on it would be cheaper to produce, and that could be an advantage for the economy overall. And we really find this argument, or the roots of this argument, already in Adam Smith's Wealth of Nations. In 1776, he has pointed out that it could be beneficial for an economy, for a society, to replace cheap paper or to have cheap paper instead of metallic money. You could use the metallic money that you would not use in circulation and sell it to other countries. That would give you a one-shot advantage when you could buy goods and services from other countries, and you could invest them and thus have an advantage of it. And then the argument is more explicit even in David Ricardo's Principles, where he says that a currency is in its most perfect state when it consists entirely of paper. But, and this is an important addition, paper that is of equal value as the gold or the genuine money that it purports to replace. So the idea was that you have paper instead of gold or silver, but it would be managed ideally in such a way as the gold standard would work. So the argument is really not about monetary policy and monetary expansion specifically, but purely about the costs. And what is interesting about the argument is that it has also permeated into some of the writings of the Austrian school. So here I've selected three important members of the Austrian school. Of course, Karl Menger as the founder, then Friedrich von Wieser, and then Ludwig von Mises, who have all at least partly or partially acknowledged the potential advantages of fiduciary media, not of outright fiat money, but of fiduciary media in the money supply. So you have Karl Menger's Encyclopedia entry in the Handwörterbuch der Staatswissenschaften on money. Geld is the original German title. There is a translation of this encyclopedia entry by Leland Jäger, which is pretty good. So if you're interested and don't read German, you can read it. And Karl Menger says, yes, it can be advantages for an economy, for a society to have fiduciary media and sell off some of the gold that would otherwise be used in circulation. Friedrich Wieser wrote in the next edition of the Handwörterbuch, wrote after the death of Menger, wrote the article on money and repeated the argument. And then, of course, Ludwig von Mises also pointed out some potential advantages of fiduciary media in his habilitation thesis, The Theory of Money and Credit. Later on in Human Action, he denied all potential benefits of fiduciary media, and this has, of course, sparked a huge debate among Austrian economists. But really the important point here is just, even among Austrian economists, the argument exists and has been taken up, and Austrian economists, more than any other economists, are known for their uncompromising stance on money. Given that even Austrians have taken up the argument, the cost-saving argument, it is also no surprise that, of course, we find it today in modern textbooks. And I have two examples here. I have the very famous textbook by Samuelson and Nordhaus, where they say, yeah, the disadvantage of metallic money is precisely that you need real resources to dig it out of the ground. And then more specifically, again, in Krugman and Wells, that's their textbook on international trade, they refer to Smith's famous metaphor for paper money as being a wagon way through the air. And then they ask rhetorically, why make any use at all of gold and silver? And of course the answer is, well, don't worry, we don't use it anymore, because having a pure fiat money is even more of a wagon way through the air, and it doesn't need any real resources except the paper that you print the banknotes with. Okay, so that's the cost-saving argument for fiat money. Of course, now we could directly look at central banks and what they actually cost in terms of their operating expenses. But first of all, we need a benchmark, right? The argument implicitly here is that, well, if we have a fiat money, we save all the resources we would otherwise use in order to produce gold money. That's the historical alternative. The question is, how much would it cost to have a gold standard? And luckily, we have some estimates. One of the first estimates was given by Milton Friedman in the late 1950s and early 60s. And Friedman tried to estimate the annual resource costs of a gold standard relative to GDP. So we have delta G, which is the nominal value of the change in the gold stock. And Y is nominal income or GDP. And he decomposed this fraction that he wanted to estimate into three parts. So we have, first of all, delta G divided by delta M. So that's the nominal value of the change in the money stock divided by the change in the nominal value of the gold stock divided by the change in the money stock, times the change in the money stock divided by the money stock, so that's the percentage change of the money stock, times the money stock divided by nominal income. And the money stock here, and that's important in Friedman's estimate, is M2. Okay, so it's not the base money supply, it's not M1, it's M2. It's very important. I will explain that a little later. Now, Friedman said, okay, we have these two factors and we can find empirical estimates of those. Okay, first of all, Friedman said, okay, we want to have a 100% gold standard, 100%. We want to estimate the cost of such a gold standard. And again, he said 100% on M2, which is, of course, somewhat tricky, because even the most outspoken advocates of the gold standard say we would want to have 100% on M1. But okay, so this means that the fraction delta G divided by delta M is 1, okay? Every increase in the money stock, delta M, is completely, there is an according increase in the gold stock. So this fraction is 1. Furthermore, Friedman said, well, if we want to have price stability, then the fraction delta m divided by m must be 4%, because considering real economic growth, having an expansion of the money stock by 4% would roughly ensure price stability. And then he empirically estimated the fraction m divided by y and said this is about 62.5%. Okay, so the money stock M2 divided by nominal income is about 62.5%, and we put this all together and we find, okay, the annual costs of the gold standard, of a 100% gold standard, 100% on M2, would be 2.5% of GDP every year. Okay? That's somewhat of an exaggeration, and Lawrence White has pointed this out. His argument, however, is that, well, if we want to have a gold standard, we would of course not have a 100% gold standard, but we are content with having 2% reserves. 2% historically have existed, for example, in the free banking period in Scotland that Larry White has, and George Selgin, of course, have studied. And if you make this change, if you change the reserve ratio from 100% to 2%, your estimate goes down to 0.05% of GDP every year. So this looks much better already. However, Lawrence White suggested another adjustment, because when he presented his estimate, that was in the 1990s, some decades later, he said that the velocity of money had increased so that a 2% money growth rate would be sufficient to have price stability. So he reduced the 4% of the money growth rate down to 2%, and the costs go even further down. Okay, so this estimate is done 2% gold standard, fractional reserve gold standard would cost every year about 0.025% of GDP. Okay, you can ask, can we lower this costs even further? And yeah, there are at least two arguments why the cost could be even lower. Lawrence White himself pointed out that, well, if we have a gold standard, we could still replace genuine gold coins by token coins that would reduce the cost further. But more importantly, I think, is an argument that Roger Garrison presented, and he said if we really had a free banking system, of course we wouldn't have an expansion of the money stock in such a way that there would be price stability, so that the overall price level wouldn't change at all. Because the price elasticity of supply of gold is not perfect. Okay, when you have real economic growth, this would translate partly into a reduction of prices. So you would have price inflation to some extent in such a monetary environment. And so if you accept this and say, okay, we would have price deflation, the money stock would actually expand slower than, say, 2% that Lawrence White suggested, then the costs, of course, go down even further. But again, you could also argue in the opposite direction and say, well, 2% reserves is excessively low and is not really representative of a genuine gold standard. So what happens if you increase the reserve ratio? And what you can do here is, of course, well, let's take the Rothbard's suggestion of 100% reserves on M1. If you do this, then the costs would roughly be, taking the other numbers that Lawrence White uses, would be about 0.1875% of GDP. Okay, then you can argue in other directions, can say, well, the velocity has changed, real economic growth has changed. So we round this number up and say, okay, we have an upper bound benchmark of 0.2% of GDP every year for a 100% gold standard on M1. And this gives us a range of estimated values. Okay, we have a very optimistic lower bound, 0.005% and 0.2% of GDP. Those are the costs that we want to save with a fiat money system. And now let's look at the expenses of modern fiat money systems. And here we have the costs of the Eurosystem. Unfortunately, the Eurosystem doesn't publish a consolidated annual report, so I looked at the annual reports of every national central bank. In the upper left panel, you have the smaller founding members. In the upper right panel, you have the bigger founding members, and also Greece, which is somewhat of an exceptional case. In my earlier publication, I discussed Greece a little in more detail. And down there you have the joining members over time, and on the bottom right panel you have the overall cost structure, or the overall costs, including expenses for staff, administrative expenses, expenses for banknote and coin production, and some other items that are given in the annual reports and in the annual financial statements of the central banks. And the overall costs amounted in 2016 to about 10 billion, which is roughly 0.09% of GDP of the Eurozone. So you see we are in the same ballpark as the cost for the gold standard. If we look at the Bank of England, they are a bit more cost efficient, although the trend is also increasing. In 2016 and 2017, the overall expenses of the Bank of England were 412 million pounds and 647 million pounds respectively, which corresponds to 0.02% of the GDP of the United Kingdom. Here we have the costs of the Bank of Japan, which is the most expensive of all the central banks or central bank systems relative to GDP. In 2017, the Bank of Japan had expenses of about 610 billion yen, and this corresponds to 0.11% of GDP. And then there is an outlier in 2003 where the expenses were even above our upper bound benchmark that we have calculated earlier, at 0.3% of GDP. And finally, the Federal Reserve System, which is again, compared to the Eurosystem and the Bank of Japan, more cost efficient. Here, the overall expenses per year corresponded to roughly 0.02%. So what we can see is that all of these estimated or all of these reported costs relative to GDP are in the same ballpark as our estimated costs for a gold standard, with varying degrees or varying reserve ratios. Remember, our lower bound estimate is a 2% reserve standard. The upper bound corresponds to 100% reserves on M1. This is, of course, more expensive than most of the observed actual expenses of the central banks, but the costs are well within those two bounds. Okay, so what do we learn from this little exercise? First of all, we've seen, okay, the Fed and the Bank of England for some reason are more cost efficient than relative to GDP than the Eurosystem and the Bank of Japan. But in every case, we see that the expected cost savings from a fiat standard and having a modern central banking system are not as high as expected. So the argument is illusory. The classical argument for fiat money is illusory, at least when we look at these historical cases. And a return to a commodity money, whatever reserve ratio we would want to have, we can discuss this, but in general, the return to a commodity money, solely from the vantage point of the cost of production, seems feasible. Thank you very much for your attention.
So we have time for one quick question or a few quick questions answered all at once.
Mr. Israel, your lecture was highly interesting, but isn't the most important thing costs which are not, or advantages which are not quantifiable? Because when you have a solid currency backed by gold, then you have the confidence of people in the currency. And this confidence, which is, as all people say, that the most important factor of a currency is confidence. And this confidence you cannot really quantify. And secondly, when you have a stable currency, as we had between 1871 and 1914, and between 1945 and 1971, then we had a flourishing economy compared to the fiat situation in which we are afterwards. We are afterwards in a more or less stagnant situation. So these are advantages which are really huge in comparison with the minimal costs.
Yeah, I agree. Totally. There are, of course, many other potential benefits and costs that are not taken into account here. This is really a simple accounting exercise. For example, one of the costs I consider also very important is the cost of human capital. I mean, if you look at what the central banks, what the most important items of expenditure are, it's staff costs. The people working at the central banks are, on average, highly educated. So there's human capital bound in the central banks that if we hadn't this system, they would go into the economy and do something else, maybe more productive. We can argue about that. In the classical gold standard, the cost structure would be very different. You would have expenses for capital goods, machinery, and so on, and mining and other things. But yeah, there's no doubt there are other aspects that could be analyzed and should be analyzed and are analyzed. But in this paper, I take a much narrower view. Just look at the classical cost-saving argument, and well, let's see if it holds with respect to those modern central banking systems. And I think I have shown in the paper that, well, the cost-saving argument in these historical cases is not as strong and persuasive as it looks. Of course, there's a grain of truth in the argument, right? It could be much cheaper to have a fiat money, but in fact, it isn't.
Okay, we can take one more question and we have to move the rest to the coffee break.
Hello. So if a gold standard exists in a single country, like let's say the British pound right now, can it survive? And if so, does the calculation change to the costs analysis of the lecture you just had? Thank you.
Well, if we had a genuine gold standard somewhere, we wouldn't have to estimate the cost. We could look at if the numbers are published, we could look at what it costs. And this is another idea I had. Maybe it's possible to find documents that report the costs of historical cases where we had the gold standard and then calculate that relative to GDP. So your first question, could it could it survive, the gold standard, if it were implemented somewhere? And I think, yeah, I mean, it depends on the political will to do it. But in principle, I think it could, yeah.
Thank you, Karl.
Thank you.